Our assessment is that one, just like these charts have just broken out, and these charts don't break out and then sputter. These bases are too clear, too wide. It's not like I'm drawing a little 2 point trend line, subjectively. This is like 4 or 5 points spanning 11 years, and they all did it at once. So it's affirming, affirming, affirming. Something's going on here. Okay.
Yeah,
Now, most of the American public is not participating. We know that.
right.
They're very sub-level in terms of gold participation or monetary metals. That's going to wake up, especially when the stock market turns down in a way that hurts them. And we're not dealing with mortgages now, mom and pop mortgages. Okay. We're dealing with Japanese government bond implosion. Our government bonds in trouble. UK. This is too big. And when that event hits and they finally realize, central banks and the investment public, that, uh-oh, it's different this time. Something's
Yep.
really bad here.
Something big is happening in the global markets right now, and almost nobody is paying attention. Gold has smashed through new highs, silver has become one of the strongest assets of 2025, and the world's most important bond markets are flashing the same early warning signals that appeared before every major financial crisis in the last 50 years. But one voice has been warning about this shift long before the headlines caught up. Momentum analyst Michael Oliver, known for predicting the 2000 dot-com blowout and the 2007 mortgage collapse, says we've just entered the first phase of a major market reset. And the biggest clue isn't found in price, but in momentum, the long-term structural behavior that reveals where capital is quietly moving before the public ever notices. Today, we're breaking down what Oliver believes is unfolding right now, why gold and silver are acting like they've crossed a point of no return, and what investors need to understand before the next wave hits. Stay with me, because this is not a normal market moment. This is the kind of shift that defines an entire decade.
It's a relative performance chart going back to when gold really was collapsing in 2013. It was also collapsing in relative performance to the S&P, and it's reflected on the spread. You were going from 85%, and by late 2015, you dropped just above 50. That's when the price of gold actually ended then. It was $1,050. But you'll notice if you back to that 2015 low, which is like the end of the first drop, just above 50%, you could draw a line sideways from there if you wanted to. And for the last decade, gold has been either side of that level. Well, what does that mean? It means gold has been performing just as well as the S&P for the past decade. Okay. Either, if it's around 50%, then that's where it was in 2015, meaning it's held its value versus S&P. It's been weaker than that, and it's been stronger than that. Now, during that 11, actually go back to 2014 here, where that green line commences. You could draw a line across one, two, three, four, maybe five highs there, and we punched out above it at the close of last month. Okay, so what? Okay, what it says is gold is no longer going to go mealy mouth sideways versus the S&P, meaning just as good. It's blowing out of the 11-year wide base. Now,
That's exciting. Go ahead.
if I dropped this chart in front of you and didn't have a label on it and just said this is stock ABC, what would you say? You'd say, "Hey, I got to buy that guy. He's
Yeah,
going
it
to."
just broke out.
Yeah. Okay. That means it just began. Okay. This is what just began. Everybody's thinking about gold is so old. It's overbought, silver, et cetera, et cetera. It just began, folks. The relative asset class shift out of the paper US stock market bubble has only just begun to move heartily into gold. Yeah, since 2024, that last low, gold's been advancing nicely, but within that basing range. So this is a new game. That's what it tells you. It says, wake up. This is not an old trend in gold. This is brand new. The money flow is just beginning. Whenever the stock market has had a bear over the last 25, 30 years, going back 50 years, in fact, remember the 73, 74 bear in the stock market was a huge collapse. During that same time, gold was going from $30 to 200. Okay. So, opposites. Then you go to the dot-com top to the 2002 low. 82% collapse in NASDAQ, 150% in the S&P, yet gold was rising during that time. In fact, kept going for another till 2011. Then the 2007 top, mortgage top for the stock market. Didn't really pick up steam till 8, but between 2007 and 2009, the S&P got cut in half. And gold was rising. Yeah, there were jiggles in there, big ones sometimes, but basically in a major uptrend. So the money goes somewhere when it leaves the stock market. And where does it go? Well, we all know, well, it was either Chase or one of the big banks anyway, Morgan Stanley maybe, made a statement about the 60-40 rule. 60% stocks, 40% T-bonds. Okay. That's the good, stable portfolio. Okay. Well, admittedly, during the 2002 bear in the stock market, 2007 and 9, if you own T-bonds, they went up. Yields went down. Okay. So it
Right.
was an alternative to some extent. Gold was a better alternative, but T-bonds and gold were competing as places to be other than the stock market. Now that ain't the case, guys. You got the T-bonds right now starting to break some things that if you drop about another 4 points in T-bond futures, right now they're 115 and a half. You get down to about 111 and a half, you're going to have a panic in the government T-bond market that even the Fed is going to have to step into. And they've already hinted they might be doing that soon, buying T-bonds. That's not an alternative. So if you're getting out of the stock market, like one of the big banks just said, hey, it's better now to have a 60-20-20. Okay. Now, my argument would be, how about 60% gold, 20? Anyway, but it's at least it's a realization on the
Yes.
part of big bank, part of the Fed system, that, has gold really, I guess we got to admit, otherwise we look like fools. Uh, this chart says, watch out. It's going to
Yeah.
dominate when the flow comes out of the paper bubble, it's going to go here because T-bonds aren't acting well, and it looks like they're going to cause some pain and maybe even some headlines for the stock market. The top chart's XAU index, which has been around since the 1980s, gold and silver miners, okay, Philadelphia index. So it reflects the miners, and you'll notice going back to 2014 or so, well, you had a downtrend line, you hit 1, 2, 3, 4 times, including back, several months ago, you hit it and backed off, and then you blew through it last month.
Yeah.
Okay. Well, again, here now it's echoing what gold says. Gold's beating the S&P, just broke out of a massive base. The miners say, "Hey, me too." Okay. Now, and then one below that is silver.
Yeah. Let's talk about silver. It's been just ripping here. Yeah.
This is
Talk about
last
that.
month's close now. We're higher than that now, by the way. Okay, but S&P versus silver versus S&P. Again, in the bear trend from 2011 to 15, silver went down, relative performance went down. But as you can see, either side of about what is that level? 6.5, 6/10 of a percent. Price of silver expressed as a percent of the S&P. It went sideways basically since 2018, really.
Right.
Yeah,
Yeah.
there's a downtrend structure though. And when you broke through that last month, big time, um, and you're further up now, it says the same thing gold says versus S&P. Okay, so it's a chorus. It's not just gold, it's the gold silver miners. It's silver all saying, hey, thumbs down on the stock market. And it's just broken out. You don't break out like this and have a 3 month rally.
Yeah.
This is something that involves years, a couple of years at least. So the asset shift the earthquake has occurred, guys, but nobody's noticing it. All they're noticing is what RSI says on a weekly.
Michael Oliver's message is clear. Gold, silver, and mining equities aren't just rising. They're breaking out of massive, decade-long momentum bases that almost never appear unless a new structural trend is forming. Silver has already pushed above the boundaries that have held it since 2021, while gold has shattered an 11-year ceiling in its relative performance versus the S&P 500. Oliver says if these charts belonged to any regular stock, Wall Street analysts would be screaming buy, because breakouts this wide and this clean mean the trend is just beginning. What makes this moment so crucial is the alignment across the entire monetary metal complex. Gold is outperforming equities. Silver is outperforming equities. Miners, which often act as early indicators, have broken out of decade-long downtrends. When multiple long-base structures fire at the same time, it's not noise. It's a coordinated capital migration. Now add the real-world backdrop. Stocks have been moving sideways, showing the same topping behavior seen before 2000 and before 2007. The rallies are thin, weak, and momentum-driven instead of fundamentally supported. Meanwhile, the bond market, historically the safe half of a 60-40 portfolio, is signaling stress. Yields remain high, liquidity is fragile, and several Treasury auctions in 2025 struggled to attract foreign buyers. When bonds and stocks weaken together, the system forces capital to find a new home. Silver, in particular, is positioned for something bigger. Industrial demand from solar, electronics, and EVs is hitting record highs. At the same time, silver's monetary breakout is playing out exactly as Oliver warned. Quiet at first, then accelerating quickly as the relative trend turns. This dual role, industrial plus monetary, gives silver an explosive setup that rarely aligns at the same time. And while gold's recent breakout above $4,000 captured headlines, Oliver argues that the real story isn't the price. It's the momentum, the shift that shows where institutional money is already moving. Momentum doesn't lie. It turns long before price, and every major financial rotation in history has begun with structures just like these. This isn't a quick rally. It's the opening stage of a multi-year transition, the kind that most investors only understand once it's already too late.
Our assessment is that, one, just like these charts have just broken out, and these charts don't break out and then sputter. These bases are too clear, too wide. It's not like I'm drawing a little 2-point trend line, subjectively. This is like 4 or 5 points spanning 11 years, and they all did it at once. So it's affirming, affirming, affirming. Something's going on here. Okay.
Yeah.
Now, most of the American public is not participating. We know that.
Right.
They're very sub-level in terms of gold participation or monetary metals. That's going to wake up, especially when the stock market turns down, in a way that hurts them. They notice. We argue technically that the stock market has been in a topping process since late last year, early this year. At that point, early this year, for example, S&P was just below 6,200. Okay. So you drop, we got about 10% out above that high recently, and we're just sputtering up here for 3 months now, spinning wheels. Our work on the S&P says this is virtually similar or the same as the 2000 dot-com, 2007 top. It was complex. It didn't just occur and then collapse. It was laborious. And in fact, each time they teased you with a new high after MSA declared, get out of this market. Several months later, in both cases, it went up and made a new high, just enough so CNBC could report a new high. And you could hear the cheering. It was a trap. Okay. Also, they're expecting what right now? Oh, the Fed's going to cut. Heck, maybe they'll surprise us and give us a half point. Oh boy. Every time the Fed has started cutting in a serious way, that marked the end of the bull market. In fact, 2001, they started cutting in January. It was a handful of months off the high, not much price drop. They started cutting constantly. Market imploded. 2007, they printed the top tick almost. Mid-September 7, they peaked like 3 weeks later in October, and that was it. Okay, so anybody cheering Fed rate cuts, it hasn't done their homework. It's not what you want because it says something. Anyway, but that's fuel for the monetary metals. Pedal to the floor, So anyway, all these pieces fit together. And that last one I mentioned, the T-bond thing. The T-bonds, something's wrong there. We all know fundamentally, Jamie Dimon said you just can't keep doing this every decade type process where the government debt to GDP and all this. It can't just keep it pushed off. And he said this time probably going to be different. Well, I think it will be. And in fact, watch the T-bonds because they've been comatose for about 3 years now. And right now at 115.5, they're sort of in the lower quadrant of the price level of the last 3 years. So in other words, very anemic, yields very high. The Fed rate cuts don't affect them. Watch out that beast because he drops another 3 points or so below where you're trading right now. The March contract T-bond futures. You could get a rapid flush, meaning sharp spike. That's going to panic people because nobody expected it. And also it eliminates that quote alternative. Now you're down to one. So what I'm arguing here, wet bar of soap time. There's only one thing to grab. Okay. And I think it's beginning, and I think these spreads know it. And that's what well, the head of the president of the New York Fed, Williams, I think it was about 3 weeks ago, made a statement or a press conference, and I'm sure it was approved from higher ups in the Fed. The Federal Reserve is going to probably need to start buying T-bonds, he said, or buying bonds, quote
Think
unquote.
about that.
And but not because there's in trouble. He didn't say that, of course, naturally. He said because of illiquidity. Oh, isn't that nice? I'm so glad they're taking care. They're nervous. They're nervous as heck about government debt market. And we're not dealing with mortgages now, mom and pop mortgages. Okay. We're dealing with Japanese government bond implosion. Our government bonds in trouble. UK. This is too big. And when that event hits and they finally realize, central banks and the investment public, that, uh-oh, it's different this time. Something's
Yep.
really bad here. That market's bigger than the US stock market, US T-bonds.
Yep.
So you can't ignore it. Watch it.
Commodities are ripping here. And you show some charts. Talk about that.
Yeah, top chart goes back to 2007. It's the Bloomberg Commodity Index, which is a well-balanced index of commodities, energy related, base metal mining, sugar, cocoa, sugar, cotton, grains, a very broad metric of commodity complex. In 2008, it peaked at 237. Top left chart, that's a price chart, okay?
Right here.
Collapsed down to 100, then rebounded in 2011 when gold peaked and reached up to 170 something. Yeah.
Yep.
But look where it dropped to since. That last red circle is in 2020. That's when gold had doubled between its low in 2015 and 2020.
This is a great chart. Go ahead.
But Bloomberg went down. Okay, so it wasn't correlated to the gold. Then we had the explosive upside. The MSA called at a price of about 70. We said you could probably go up to about 140, and that's where you peaked. Why? There's a channel top we projected there. Sure enough, that channel top worked. Look where we are now. Now, this is as of early this week. We're already higher than that. We're pushing toward that line, that red channel top. What is that channel? We take the three lowest monthly price closes going back to 2009, I guess it was, or 2000. Yeah. 2008. And line them up, and there's a nice perfect line through three low closes. It's the same angle of descent we plot through the high monthly close that occurred in 2011 and project it down. And sure enough, that rally was up into thin air, but that line, when we projected it, said, hey, that's a good place to reflex at. But it's a theoretical channel top. It reflexed. Happy. That means that channel is valid. You close a month out anywhere near 120. Right now, Bloomberg's 112 as we speak. You're going to break through that price channel that goes back, 2008. Okay. Now, here's annual momentum below. This is measuring the monthly action versus his 3-year average. You had the burst, the breakout that occurred before the price surge. You went off the page to the upside. It says, hey, I'm out of here. Damn it. I shouldn't have been here. Okay. And even then, it got to 140 in price, which is still like 100 points short of the 2008 high. Okay, after that peak in March of 2022, weeks after the war began in Ukraine with Russia, commodities peaked 3 weeks after that war started, and the momentum dropped back down. And for the last couple of years, it's lived just below the zero line, a little red horizontal on that bottom chart, or below the 3-year average. Yeah. We broke out of that in October. At just above 106. Now we're up to 112. Okay.
Right there.
That is a statement by momentum that, hey, I'm out of this base. I'm through with my correction. I'm headed for my next wave up. And we only, and I think there's a multi-wave process here over a span of years. Commodities are vastly underpriced as an asset compared to anything, compared to their own highs, compared to the S&P. This is a place secondary to monetary metals, but this is a place for investors to look hard at stock-related positions in the commodity asset arena, energy-related, base metals, grain-related, fertilizer, all those. Throw darts at them. They look poised to be a place to be on the upside while the stock market in general goes down.
Here's what you need to know as we wrap up. All the insider signals are flashing at the same time. COMEX silver inventories at decade lows, repeated backwardation, gold holding above $4,000, weak treasury auctions, foreign buyers stepping back, and mining supply tightening just as global demand hits records. These are the signs professionals watch, not the headlines. And they're pointing in the same direction Michael Oliver warned about. We're at the beginning of a major shift into gold and silver, not the end. If you want to stay ahead of this reset, not react after it hits, make sure you're subscribed. Hit the bell, stay locked in, and share this video with someone who needs to understand what's really happening beneath the surface. I want to hear from you. Do you believe gold and silver are entering a long-term bull market, or do you think this is just a temporary spike? Drop your answer below. I'm reading every comment.